45,000 vehicles crossed it that day. That is 45,000 commuters, truck drivers and families, paying their tolls, unaware that the company collecting their money had already defaulted. The company that owned the road could not make payroll on its debt. Not because traffic stopped, not because the road closed. $196 million a year in toll revenue, and it still filed for bankruptcy. September 22, 2014. The Indiana Toll Road, one of the most strategically located interstate routes in the United States, went to Chapter 11. This is not a story about a failing business. This is a story about a mathematically perfect business, destroyed by the people who valued it. Today, we perform the autopsy. Here is what we are pulling apart. First, what actually killed the Indiana Toll Road? It was not the recession. The recession was the trigger. The cause was engineered into the deal 8 years before the filing. Second, the 3 signals the math sent before the collapse. Each one was measurable. Each one was visible. Each one was rationalized away. Third, whether a toll road, structured correctly, is one of the strongest infrastructure investments in the world, and what correctly means in specific numbers. Let's open the file. The Indiana Toll Road runs 157 miles across northern Indiana, from the Ohio border to Chicago. Interstate 90, the primary freight corridor connecting the Midwest to the eastern seaboard. No legal alternative at highway speed. Infrastructure investors call it a captive market. In 2006, the state of Indiana auctioned a 75-year operating lease. The winning bid, $3.85 billion, paid up front. The state funded a decade of transportation projects. The consortium took ownership. 8 years later, Chapter 11. Total debt at filing, $5.96 billion. Actual annual toll revenue at filing, approximately $196 million. Annual debt service obligation, over $190 million. The road was earning less cash than it owed in interest every single year. From the moment the deal closed, $3.85 billion in debt against approximately $196 million in actual revenue. The math doesn't close, it never did. The investigation begins with the immediate trigger. 2008, the financial crisis. Fuel passed $4 per gallon. Consumer travel falls. Freight volumes drop. Vehicle transactions declined more than 10% in 2 years. For most businesses, survivable. Cut costs, draw on reserves. For a road carrying nearly $6 billion in debt against $196 million in annual revenue, 10% less traffic meant the difference between barely servicing the debt and defaulting on it. But here is what the investigation reveals. The traffic didn't fall because of the recession. The traffic fell to the level it should have been at all along. The projections used to justify the $3.85 billion purchase price were built on assumptions that were wrong before the ink dried. The recession didn't create the problem. The recession revealed it. To understand the cause root, start with something simple. Think of it like this. You sign a 20-year lease on a restaurant, $5,000 per month, because a study projected 200 customers per day. The study was conducted in peak summer next to a beach. The customers exist, just not consistently enough to cover the lease. That is the structural flaw inside every toll road concession sold at a competitive auction. $3.85 billion for a 75-year concession is nearly 20 times actual annual revenue, financed almost entirely with debt, for an asset that can only grow as fast as traffic grows. At the toll road's 2006 traffic levels, the maximum sustainable debt load, the amount the road could service without going cash flow negative, was approximately $2.1 billion. The consortium paid $3.85 billion, $1.75 billion above the ceiling. Financed at rates that required traffic to grow at 3 to 4% annually just to keep up with interest payments. Traffic grew at 0.8%. And here is the sentence that every infrastructure banker in the world memorized after 2014. The toll is guaranteed, the traffic is not. 3 signals appeared before the filing. Each one was measurable. Each one arrived with enough time to act. Signal 1, the ramp-up gap. Visible in the first quarterly report after closing. Every toll road concession has a maturation period where organic traffic builds toward projected levels. The Indiana toll road's purchase price assumed it was already at mature, steady-state traffic in 2006. It was not. The discrepancy appeared in the first quarterly report. The debt structure was never adjusted. Mature traffic assumed. Immature traffic delivered. For 8 years. Signal 2, the fuel price shock. Visible in 2008. When gasoline crossed $4 per gallon, commercial trucking rerouted to avoid toll costs. Losing truck traffic hits revenue harder than losing passenger cars by a factor of 4 to 8. The stress tests modeled high fuel prices as temporary. They were not. Commercial revenue, the highest margin category on any toll road, declined at 4 times the rate of passenger volume. Signal 3, the competing route problem. Visible from the day the lease was signed. A parallel route runs free across northern Indiana. It is slower. For commercial freight under economic pressure, slower and free beats fast and expensive. The toll road was a monopoly on the fastest path, not a monopoly on the only path. That distinction was worth approximately $200 million in cumulative lost revenue between acquisition and bankruptcy. Monopoly pricing assumed, route substitution delivered. For 8 years. 3 signals. 8 years. 1 outcome. All of this, the ramp-up gap, the fuel price sensitivity, the competing route, was present in the public traffic data before the consortium signed the concession agreement. The ramp-up gap was visible in the first quarterly report after closing. The fuel price sensitivity was documented in every trucking industry study published before 2008. The competing route was on every map of northern Indiana. Every signal was visible. Every signal was priced as if it didn't exist. That is what buried economics means. Restructuring in 2009 would have cost approximately $800 million in principal reduction. They did not restructure. By 2014, creditor losses reached $2.3 billion, enough to fund the Indiana Department of Transportation's annual budget 3 times over. The road itself never stopped running, 45,000 vehicles per day, through the entire Chapter 11 process. Revenue kept flowing. The infrastructure did not fail. Here is the contradiction this entire deal tried to hide. The system spent $3.85 billion to acquire the road. The investment deck projected $328 million per year in revenue at full traffic maturity. Actual delivery at the time of filing, approximately $196 million. The debt service required over $190 million per year just to stay current. The road needed traffic to grow at nearly 4% annually simply to reach the revenue level the model required. It delivered below 1%. The road didn't break. The mathematics that purchased it broke first. The Indiana Toll Road is not the only file in this drawer. 3 years earlier, March 2010, a major toll expressway in San Diego declared bankruptcy. $847 million in construction cost. Opened in 2007. Traffic projections at opening, 41,000 vehicles per day by year 2. Actual traffic, 22,000 vehicles per day. 54% of projected volume. The expressway was sold in 2011 for $214 million. Less than 25 cents on the dollar. 2 toll roads, 2 bankruptcies, 2 states, 1 pattern. Traffic projections built to justify a purchase price, not to reflect reality. Debt structured to those projections, reality delivering roughly half the assumed volume. The road was not the problem, the model was, and the model was wrong in the same direction. Always optimistic, because optimism wins competitive auctions, and winning auctions is how infrastructure funds raise their next fund. The deck projected $328 million in annual revenue. EBITDA at 60%, $197 million. Required debt service, over $190 million. On paper, viable. The calendar delivered $196 million in actual revenue. EBITDA, $117 million. Debt service, over $190 million. Net cash, negative. Every year, from day one, the gap, $132 million per year. Before any traffic decline, before any fuel price shock, before any competing route substitution. Compounding from the first day. The contrafactual, if the road had been purchased at $2.1 billion instead of $3.85 billion, Calibrated to actual traffic, not projected traffic, debt service would have been approximately $105 million annually. EBITDA of $117 million covers that. Net cash, positive. Every year, no bankruptcy. The road, purchased at the correct price, was a viable asset for 75 years. Purchased at nearly 20 times actual revenue with maximum leverage, it was a mathematical certainty of default. The same road was acquired out of bankruptcy in 2015 for $5.72 billion. Same road, same location, same captive market, different debt structure, calibrated to actual traffic. Today it operates profitably. The risk-free rate on a United States Treasury bond in 2014 was approximately 2.5%. A toll concession structured correctly generates approximately 3%. 3% with traffic risk, political risk, competing route risk, and refinancing risk every 7 years. To marginally beat a government bond. The difference between a viable toll road and a bankrupt one is not location, not traffic, and not the economy. It is the gap between what the traffic model assumed and what the traffic actually did. The toll road doesn't fail because the cars stop coming. It fails because someone confused a guaranteed revenue stream with the ability to carry unlimited debt. 45,000 vehicles crossed the Indiana toll road on the day it declared bankruptcy. The asphalt was fine. The toll booths were operational. The cash was arriving. The spreadsheet killed it, not the road. And the same spreadsheet is sitting on a desk near you right now. That is not a metaphor. That is the math.